Hello and welcome to the 20th of our ACCA P7 Advanced Audit and Assurance lecture recaps. This one was on internal audit. So, the activities that internal audit undertake. They will review authorization of transactions to make sure that they're authorized. They'll review internal policies. They may also review, monitor or recommend systems improvements. They will undertake risk assessments. They'll look for compliance with laws and regulations. They may undertake special investigations, such as into fraud. They may evaluate information, for example financial information or operational information. They'll undertake value for money audits, and remember that's the 3 E's that we looked at in our assurance lecture. So the syllabus requires us to compare this to assurance. So for various aspects on internal audit, what do they actually do? Well, their objective is to add value to the business. They need to justify their existence by adding value and improving operations. How often do they do this? Well, it's an ongoing function. They're part of the business. They do this all the time. Their scope will be flexible and set by management or preferably the audit committee. The legal basis, well, the combined code says you should have an internal audit department, but there's no legal basis for that. Reviewed, well, it'll be reviewed by the internal team. The output will be in the form of establishing weaknesses and giving recommendations. And the audience will be management, i.e. you're recommending to management how they can improve systems. The approach, well, that's the same as audit. It's a risk-based approach. So do know all of those things regarding internal audit. Comparing that to assurance engagements then, well, their objective is to provide assurance over a particular area, as we looked at last time. How often will they do this? Well, it'll be a one-off, so the business will call the auditor in on a one-off basis to give assurance over a particular area. The scope can be set over specific areas depending on the statute, depending on which area that is. The legal basis then will be in law. The reviewers will be the external experts, i.e. the external firm. The output will be in the form of an assurance report. The audience will be the shareholders, and the approach will be risk-based, the same as internal audit. So do know the differences between your internal audit function and assurance engagements. So if you're a business that has many different locations, many different sites, so subsidiaries and departments we're talking about here, that will have specific requirements on internal audit. You can take different approaches to covering all of these sites as an internal audit department. You may make regular visits, and that'll be good for if you have a small number of locations, not lots and lots of different locations, or if your locations are close together, if you have a large audit team, or for getting coverage of the whole business. Several problems with this. Travelling from site to site will be difficult and expensive. You'll need more staff to get good coverage. The cost will be higher, and it'll be harder to coordinate. So making regular visits will have those problems. Having random visits, well, this will be good for getting a true view. If you have a random visit, you don't tell people when you're coming, they're unlikely to have prepared for it, so you'll get a true view of what's actually happening in the business, and you'll also have the same advantages as you do for regular visits. The problems will be the same as for regular visits in terms of cost and coordination, and it has a problem with regards relationship. If you're just turning up at a site, you haven't told people you're going to be there, they won't like it, and it may damage relationships within the business. Cyclical visits then, visiting each site on a 2-year basis or on a cyclical basis. This is good for coverage, so you do cover everywhere, and it's good if you've got a small audit team because you can use that audit team more effectively. However, several problems with it. There's going to be more time between the visits, so it means that some sites will go longer without having had a visit. It'll also be more complex to organise and will need planning. Lastly, more visits to larger sites. So this means taking the larger sites and visiting them more often than the smaller sites. This is good for having a risk focus. Remember that auditing is all about focusing on risks. So if you're going to the larger sites, that's going to be where your more material risks will be, and therefore that will have a risk focus, and it'll be easier to plan. If you've got many locations, this may be the way to go. Problems with it, well, again, you're maybe not covering all the sites every year. You're going to have to cover the larger sites and then the smaller ones when you can, and you may therefore miss problems that may be occurring. So, types of internal audit. I'm going to look specifically at two types. Operational audits. So operational audits will be around the operations of the business effectively. So you're identifying operational risks, you're looking for whether there are sufficient internal controls, are those internal controls complied with, are they effective, and have there been any changes in operations that mean that the internal controls are no longer effective. You'll look for those control weaknesses and try to improve the 3 E's that we've talked about. So those will be your operational audits. This is as opposed to compliance audit. Compliance audit surrounds the compliance with laws and regulations. So the first step is to identify applicable laws and regulations, to look at the potential penalties if you don't comply, to look at the processes and procedures that ensure compliance. Are they sufficient? If those processes and procedures are followed, no point in having them if you don't actually undertake them. And therefore, is the business compliant with the laws and regulations that it's supposed to comply with? So that's the difference between operational audits and compliance audits. There may be a case for outsourcing your internal audit department. The advantages of doing this are that it may provide more independence. Expert staff will be provided by the outsourcer. It may be more flexible. You can alter the contract. You can pass on that risk to the outsourcing firm. They will be bound by ethics because they are a professional accountancy firm, and it may be more cost effective. I have a question mark because oftentimes the fees that they charge will outweigh the cost effectiveness. Disadvantages: well, you may have culture clashes within the two firms. They may not have the knowledge of the business that an internal audit function would have if they were within the business. And again, as I mentioned, the cost may actually be more than having your own internal audit department. So that was our lecture on internal audit.